welcome. You're watching Your Money Matters here at NDTV Profit. I'm Mahima Vachhrajani, and this is a show, of course, which solves all your money-related problem. And today we are going to talk about one. If you have got a good sum of amount saved, then should you be investing that entire amount in mutual funds, or should you go via the PMS route, that is Portfolio Management Services? And the second one that we're going to talk about is best categories of mutual funds for the next decade. To take both of these conversations ahead one by one, of course, first we'll be talking about mutual fund versus PMS. And to take this conversation ahead, we're joined by Kumar, who's a CFA, managing partner and co-founder at Zvest Financial Services, joining us now. Harsh, thank you so much, first of all, for taking out the time. My first question to you is that, if we try to compare these two aspects, right, PMS versus mutual fund, when is it advisable to kind of go via the PMS route, and when is it advisable to go via the mutual fund route? Because, of course, there is a limit in place as well, right, when it comes to PMS.
Right. So, Mahima, thank you for having me. And before I start the conversation in a lighter vein, I just wanted to draw an analogy with the Bangalore traffic. Just because you own a luxury car which costs 3 times more than my smaller car doesn't mean that you will reach your destination 3 times faster. Rather, I could reach faster in my small car given the condition of the road and the traffic. Having said that, let's critically analyze these two categories. But before I do that, I would draw a caveat here that in our conversation, we would be comparing equity mutual funds versus equity PMSs, because right. I'm not discussing the debt PMS here because of EPFO contribution being routed through debt PMS. The numbers may look very, very different. Absolutely. Now, let's compare these two categories. Yeah. So first is about the category size. So if I look at the mutual fund industry today, there are close to around 570 odd pure equity mutual fund. Here I'm excluding index funds, ETFs, and hybrid funds. And they're close to around 50 mutual fund houses, and they manage around 35 lakh crore in this. On the other hand, if I look at PMSs, there are around 520 portfolio managers. There are close to around 1,400 schemes. And the AUM which they're managing is around 4.25 lakh crore, out of which 90% is discretionary, which means the fund manager has all the say when to buy, what to sell, when to sell. If I look at the number of investors, they're close to around 2.1 lakh unique investors in PMS, while the number for mutual fund is 6 crores. If I look at the distribution ecosystem, there are close to around 22,000 distributors who are empaneled to sell or advise PMS, while the same numbers for mutual fund is around 1.9 lakhs. So we are comparing two different categories with very different size and ecosystem supporting them. Right. If I look at the growth of these two categories, now you would generally assume that the category which is young, which is upcoming, would be growing at a faster pace. But if I ignore EPFO flows, the growth in PMS of the last 3 years has been at around, say, 27% CAGR, while the same for mutual fund is 24%. So first thing first, it tells us that there are takers for both the categories, and even at 35 lakh crore of pure equity mutual fund and at 81 lakh crore of overall AUM, mutual fund is still holding strong, and it's growing at a faster pace and comparable pace to PMS. Now let's look at the performance, because before we get into who should invest and all, let's understand all the finer nuances.
Sure.
If I look at the performance, now let's compare it with benchmark. And here again, I would compare only one benchmark, which is a Nifty 500 TRI, because that encompasses around 96-97% of the market, and we don't have time to get into differentiated benchmarks. If I look at mutual fund, and if I go by the last PIVA report, over the last 3 to 5 years, close to 20% of the large cap mutual funds have beaten benchmark. And if I look at small and mid cap, then the number goes as high as 60% over the last 3 to 5 years. But if I look at PMS, then in large cap, the number is same as mutual fund, around 20% beating benchmark. But when it comes to multi-cap, small cap, mid cap, then the number shrinks significantly to 30-35%. So first, it doesn't mean by any stretch of imaginations that PMSs have beaten benchmark or their mutual fund counterparts significantly over the last 3-4 years. Rather, they have even beaten or not, that will come to the next. But there is an exception to the rule. If I look at top 5% PMSs, and if I compare their performance with their mutual funds, top 5% performers, then the difference is very, very stark. if I just look at last 1 year as an example, the best performing mutual fund would have been giving return, which is 10 to 15% lower than PMS, where it is as high as 42%. But for investors, before they jump into this, they should understand the range of return also. In PMS, the best performing PMS in last 1 year has given 41% return. The worst performing PMS has given minus 23% return. And mind you, I am only comparing PMSs which are above a certain threshold of AUM, which is 1,000 crore in my working. Whereas in case of mutual fund, the range is very, very small. So what we are interpreting from this is that if you're getting into the PMS, if you are in those top 5% which have delivered a significant amount of alpha, you will be very, very happy. But on the other hand, if you are in those PMSs where you have had to have the bottom end of the curve, then you would have lost significant amount of wealth. So based on this, it becomes very important that the manager selection when you do in a PMS is way too more critical than what you do in mutual fund.
Right.
Now, the important point which I would want to mention here again, before we take the conversation further, is that when I say returns in mutual funds, these are net of expenses. When I say returns in PMSs, these are gross returns, and you have to reduce expenses from this. Second, mutual fund, you can prolong your payment of taxation. You can defer your taxation by deciding when you want to sell. Whereas in case of PMS, there is a tax drag also. And if you are investing in a PMS where the churn is very, very high, then you would see a significant amount of tax drag. And third, and the most important variable, in case of mutual funds, let's say I'm investing 500 rupees and you are investing 5 crores. Over a time period which is same, which is say let's 1 year or 2 years, you and I make same amount of returns. In case of PMS, the return in the same scheme for two investors can be different depending on what exclusion they would have chosen, what kind of fee structure they would have chosen, and those kind of things. Now that we have understood this, and now coming to your question on who should invest in PMS and who should invest in mutual fund.
Yeah.
So PMS, first let's come to mutual fund. A mutual fund is extremely suitable for somebody who's starting his investment journey, where the corpus is small, because in mutual fund you can start an SIP with as low as 100 rupees these days also, which is not the case with PMS, where the minimum ticket is 50 lakhs. If you are an investor who want an average return over a longer period of time where you are happy beating benchmark by 1 or 2%, then mutual fund is the place for you. But if you are an investor who wants sizable alpha over benchmark, then you need to look at concentrated portfolios, and PMSs come handy there. If you are an investor who's not wanting to get into the hassle of paying taxes every quarter, paying advanced taxes based on the gains which you have in PMS, then I think mutual fund is for you. If you're an investor who saves on a monthly basis and want to stagger his investment over the period of next 5, 10, 15 years, then also mutual funds are simple instruments to invest, because in PMSs also these days there are some PMSs which offer SIPs, STPs, but they are not as seamless as you see in the case of mutual fund.
Okay.
Now let's see who should invest into PMS. First is somebody who want exclusion. Let's say you're on the board of a company, you don't want to invest into a particular stock. You can go for PMS and you can exclude that stock from your portfolio. If you have, because of your ideology, your faith, your religion, you don't want to exclude certain categories like liquor, tobacco and all, you can go for PMS. Thirdly, if you are a US citizen or a US taxpayer and you want to invest into India, and now you have Gift City route also available, their PMS is much better instrument, because under PFIC guidelines, mutual fund gets a very complicated treatment in comparison to a PMS. So these are the guidelines which you should keep in mind. And lastly, I would say that some people say that when you have a portfolio of 1 crore, 2 crore, you should get into a PMS. I would strictly advise against it. Let's say you have a portfolio of 1 crore or 2 crores and you invest 50 lakhs into a single PMS scheme, that becomes 25 to 50% of your portfolio. And if that doesn't perform the way you would have anticipated, then you can have a significant drag on the portfolio. So I would suggest, unless you have 4 or 5 crores, don't think of investing into PMS, because otherwise the weight of a PMS in your portfolio would be sizable, and it may be beneficial, it may go against you as well.
Got it. Is amount the only consideration, Harsh, to choose between PMS and mutual funds? Because I feel that taxation is also a point of view, right? Because PMS will keep buying and selling counters, and that could lead to a higher taxation outflow. So then, how does one choose between returns, taxations, as well as the kind of amount that one has? Of course, 50 lakhs is the limit. Beyond that, only you can go ahead and choose a PMS. But taking all that into consideration, when does PMS actually become more, better in terms of comparison to mutual funds?
So, Mahima, let's try to understand again through multiple dimensions. So, the first thing is a minimum ticket or a minimum threshold buys you an excess and not assured alpha. And you should be very clear about it. And this is not just true for India, but it's true across the world. I'll just take maybe half a minute to give you an example. So, way back in 2007, Warren Buffett got into a wager with protege partners, and Warren Buffett had the logic that a simple S&P 500 index fund would end up beating carefully chosen hedge funds. And the bet was for a long period. It was for 10 years, which is a long period in any market. At the end of 10 years, in December 2017, when they analyzed, S&P 500 had given a return of 8.5% for that same period. Hedge funds, which were carefully chosen by smart guys, had given a return of around 3.1%. So which means the lesson here is that higher fee structure, a higher minimum investment, and a more exclusive product does not automatically translate into a better return. And this 50 lakhs, which we are discussing here, it's more of a regulatory criteria. It has nothing to do with the fund management selection of stocks and other things. So that is one part where ticket size, why is it relevant and how is it relevant? It has no correlation with the returns. The only benefit of the ticket size is that a small investor or the new investors, they tend to avoid this because they don't have that kind of a corpus. So it becomes more of a self-selection tool than a return maximization tool. Now let's come to the second part where we discussed about taxation. Give or take, there is no doubt in my mind that mutual fund taxation is far more efficient than a PMS. And let me try to illustrate with an example. Let's say you are investing into a mutual fund and you decide that you don't want to sell your mutual fund for next 10 years. There is no incidence of tax which is involved for next 10 years for your holding. Whereas if you're investing in a PMS, whenever the fund manager buys or sells a stock, if the stock is getting sold at a profit from the purchase price, there is a tax incidence which gets involved and you have to pay that tax. It's not that mutual fund manager is not churning the portfolio. Mutual fund manager is also selling and buying the stocks on a daily basis, but you are exempt on those churns to pay taxes. So it's an extremely tax efficient tool for you. And sometimes people don't appreciate it enough. But again, let me give you an example. Let's say you are holding PMSs and I am holding mutual funds in my portfolio.
Right.
Your tax liability, you are paying 1 lakh tax every year over next 25 years of your holding period. While I am trying to avoid that by not redeeming my portfolio, at a 12% assumed return, this 1% outflow of tax every year becomes 1 crore after 23 years. So which means by saving on the taxes, you are amplifying your return. So we often say in our language that, these taxes are like holes in the boat. You are trying your best to be the best oarman, but at the end of the day, these holes are dragging back your boat from moving forward, and you should avoid that. Also, if you see the new taxation regime after 2024, short-term capital gain is at 20%, while long-term is 12.5%. So even if you have a need of money after 1 or 2 years and you have to sell your mutual fund, and if you are in a gain, you end up paying 12.5%. Whereas in case of PMS, fund manager is deciding to buy and sell. And if the sale is happening in less than 1 year, then you are paying 20% tax. And there are PMSs where the churn rate is even higher than 100% in a year, which means your entire portfolio is getting churned and you are paying taxes on that. So this is about the taxation part. Now, third part is about the returns. So one thing which I mentioned at the beginning of the conversation is that if we take a top 5% schemes, there is no doubt that PMSs have done better job in comparison to their mutual fund counterpart. But these tables keep on changing every year. The 5% schemes of last 5 years are not going to be the 5% schemes of next 5 years. So let's do a comparison for last 5 years and see how things stand. If I look at Nifty 500 TRI, last 5 years, the return generated on this has been 12.1%. And I'm taking 5 years as an example and not 10, 15 years, because in PMSs, we don't have sufficient track record of last 10 to 15 years, and we don't have sufficient sample size also. Whereas in mutual fund, we have that. But let's come to the point of last 5 years return. 12.1% is the return of Nifty 500 TRI. If I see the PMSs and if I try to figure out number of PMSs above a certain threshold of AUM, let's say 500 crores, which would have generated more return than this, then close to around 88 schemes have generated better return than this, which is roughly around 16 to 17% of the universe of PMSs which was available 5 years back. Now let's look the same data for mutual funds. There were close to around 120 mutual funds which were available 5 years back, pure equity funds, and I'm not getting again into hybrid and other funds. Out of these, 103 funds have beaten 12.1% return. So what we are saying here is that in case of mutual fund, 85 to 90% of the mutual funds end up beating benchmark, whereas you don't have the same number for PMS. But again, if I look at last 5 years return of top 10 performing, then you see in mutual fund, the average performance of top 10 performing funds is 23%, while in case of PMS, it is 30%. So if you can choose a fund manager who will be in the top 5% for next 5 years, then you are better off with PMS. Otherwise, if your idea is that you want to beat benchmark and you're okay with beating benchmark in a diversified way, then mutual fund is a much better instrument for you. Again, I would say here that maybe this comparison is not very appropriate because I am taking one single benchmark here because there are certain small cap, mid cap schemes in mutual funds, but those is in the case in PMS also.
Right. Okay, Harsh, thank you so much for explaining, that entire concept in so much depth, and of course, for taking out the time and speaking with us at NDTV Profit.
My pleasure is mine. Thank you so much.